Good morning, everybody. What I'm going to talk about is that this housing cycle is completely atypical of all the post-war housing cycles we have. Normal housing cycles are normally a big crash, which is what we had, and then you get a swift and very strong rebound. The current cycle is really characterized as very slow and very sluggish. Now, what accounts for this is we have tighter credit standards this cycle compared to when we went into the housing crash in 2006. There's shifts in lifestyle preferences. There's slow income growth, and there's also strict zoning controls and employment centers, which is preventing supply from coming on, are responsible. But the other thing going on is multifamily, despite all of this, is multifamily housing continues to be in boom or near boom conditions. So this is sort of the long-term, going back to 1959, a very long, slow recovery. You take a look, we bottomed out at 500,000 units, and we're going to go up to about 1,004,000 units in 2018, 2019. But if you notice, is 1,004,000, 1,005,000 is sort of the average. We're not going back to 2 million. Well, most of the other cycles, we go back to 1,008,000, 2 million, over 2 million, and we're nowhere near it. And 1,003,000, 1,400,000 housing starts a year is essentially the long-term average. So essentially, it's long and it's slow. And our guess is it's going to continue. We have it rolling over towards the end because, as we see, we're forecasting higher rates, and ultimately the higher rates will have an impact on housing starts. So this cycle is much, much different, but it also means it could go on a longer time, and it's also, when you come from 2 million down to 500,000, that's a real crash. If housing rolls over, it'll go from 1,004,000 maybe to 1,002,000 or 1,001,000, where the previous cycles dropped. So we're not going to get hard hit on the downside when housing rolls over. Just to go back, what's underlying it is we have a modestly growing GDP. For the past 2 quarters, we had a lot of tax reduction. In the forecast this quarter, we've took out most of that, but not all of the tax reduction. We think there will be, somebody had a question on taxes, we think there will be a tax bill of some size, but it's be far more modest than what people have been talking about, and most of it probably will be on the corporate side rather than on the individual side. Employment growth remains solid. It's going to slow. You note the line is beginning to slow down a little bit. The rate of growth is because we're at full employment, and it's hard to add people into the workforce. And the last few employment reports have been kind of weak. Our sense is I think there's some very technical issues in the data. Our sense is when we get the June employment report in the beginning of July, that'll show a reasonably good number. It could even be 200,000 for the month. And all the anecdotal evidence about college hiring from here at UCLA and from Baruch College, where I have an association with in New York City and stuff like that, all the anecdotal evidence associated with college hiring is very good, and the starting salaries also happen to be very good. So to me, I think I'm going to go along with the anecdotal evidence than with the official data on this, at least near term. Okay. Other thing is I think the era of very, very low mortgage rates are ending, and I don't know whether it's going to go up as fast as we have it here, but our sense is with mortgage rates around 4 right now it's very easy to see mortgage rates going into the 5s sometime late in 2018. But no, it'll still be below where it was in 2008 and still on a historical basis reasonably low mortgage rates. The other thing that's happened is that the housing market took the shock. We had a 75 basis point increase at one time. Now it's 50. We went from 3.5 to 4.25. And if you look at all the housing data, you wouldn't notice it looking at the housing data. So the market took the immediate jump in rates reasonably well. And our sense is when employment continued reasonably strong and strong household formations, which I'll get with you later, is that we think the market will be able to handle it, at least initially. All right, here's household formations. We've been running at around 1,000,002 nationwide. We think we could go to 1,004,000, 1,005,000 in 18 and 19. And part of it is there's a pent-up demand to form households. If you take a look, we were below 200,000 in 2009, so we had 3 years of just very unusually very, very low household formations. So we think that will come back. Also notices, if you look at the household formations in 2005, 6, and 7, 1,200,000, something like that. We were doing 1,800,000, 2 million housing units at the time. So housing got way ahead of itself in terms of household formations. But we think, basically what we think is going to happen is the kids are going to move out of the basement into apartments. And the other thing is where you have roommate situations, roommates, as income rises and stuff like that, instead of living a college dorm lifestyle, you may have more people moving into their own apartment rather than in a roommate kind of situation. So we think that's also going to add to household formations. That's going to accelerate. House prices remain strong. This is the Case-Shiller index for the U.S. Jerry showed California. California were above the old highs. In the major metro areas of the state were above the old highs. The U.S. were about 5% below the old highs. Our guess is by early next year, the U.S. will exceed the old high. Now, on an inflation-adjusted basis, it's not a new high, but on a nominal basis, we think we'll get a new high. So why are starts so restrained? That's sort of the question. Why aren't we getting 1,800,000? We're only getting like 1,200,000 right now. One, we have higher credit standards, although there's an article in the Wall Street Journal today where they're saying is the mortgage banking industry is looking to hire subprime brokers. So subprime may be back a little bit. And whether that's a good thing or not, who knows? But there's a reason for having the higher credit standards, because the very, very, very low credit standards got us into all kinds of trouble. The sluggish income growth. Income is growing, but it's sluggish. Hollowing out of the middle class, so there's less middle class buyers in there to buy houses. There's been delay in life events, marriage and families having children. There's been a real delay. And the other thing is, for whatever reason, is maybe just population is older. People are staying put. In 2006 and 2005, people would move 4 times, once every 4 years. Now it's once every 8 years or something like that. And that's part of the reason why housing turnover is real slow. People are just staying put and not moving, and they're happy with where they are for a whole host of reasons. And the other thing is we have what I would call regressive zoning laws in major employment centers, which makes it very hard to build. Makes it very, very hard to build housing. And the panel is probably going to talk about that later. But I think that is a big issue across all coastal California. It's an issue in New York City. It's an issue in Washington, D.C. The only place where it's not an issue is something like Houston, Texas, or what have you, where there's very limited zoning, and the people don't worry about housing affordability there. All right, this is sort of home sales nationwide. We peaked at 7 million in 2005, dropped to 4 million. Now we're around 5 million, 5.5 million. We're sort of going to. Our view is we're sort of going to stay there. So if there's going to be relief in the system for entry-level buyers, it's going to have to come from the new construction side rather than from buying houses, existing homes. Now, what's going on is when people are staying put, they're not necessarily happy with the house they have, so they're changing the house they have, and people are remodeling. So there's additions and alterations, and this is the sales at building material and garden equipment supply dealers. What that means is Home Depot and Lowe's. That's the bulk of this money. And Home Depot, and there's also no internet competition for this thing because it's hard to sell lumber and 2x4s and drywall on the internet. And so that business is booming, and we've gone from basically $20 billion a month, this is nominal dollars, to over $30 billion a month since 2010. So part of what's going on housing, I'm sure most of you, if I ask a show of hands, how many of you remodeled, did something with your house? Could you raise your hand in the past couple of years? Lots, look at that, lots of hands. So that's what's going, you're part of what's going on. Instead of moving, you're making your house better, more livable, or new kitchens, new bathrooms, or an addition. If you think you're the kid in the basement needs more space. Okay, the other thing going on is delayed life events. And this is fertility, which is the total number of children per woman in the economy. And you see the 60s baby boom, so 1960s, 3.5. That's been cut in half. It's now down to 1.8. And that basically is part of the reason why the labor force growth has slowed. What Ed talked about is because it's true there's immigration, but there's less children in the economy. Now, how did in the 1970s, how the housing market handled this big drop in the birth rate is what happens, we got households through divorce. So instead of having one household, we had two households because of a doubling of the divorce rate between 1970 and 1980. But since before the recession, this has gone from 2.2 down to 1.8. And my friend Ivy Zellman at Zellman Associates has an interesting chart about this, and looking at what age are children being born right now. And there's been a very big drop in births of women under 25, and there's been an increase in births of women over 25, and that sort of shows up in the delay of having children is happening later. And the other thing that's going on from the point of view of the housing market is a potential house buyer is not a 17-year-old woman who gets pregnant. It's somebody more 28, 29, more stable, and having a child, and that'll generate a home, could generate a home purchase. So the chart, it isn't as bad as the chart looks. But the other thing, we've been forecasting for the past 3 years that the home ownership rate would finally increase. Well, for the last 2 quarters, it's finally happened, but we've been saying that for 3 years. And now it looks like this time it's for real. Home ownership went from 64% to 69% from the mid-90s to the mid-2000s. It dropped down to 63%, and we think we're sort of leveling off right now, and let's call it at around 64%, level. Okay, now what's going on in contrast is multifamily is in a boom. We went from below 100,000 starts to over 400,000 starts. That big surge in 2015 is all New York City because there's a change in New York City tax incentives, so everybody jumped in and built houses. New York City at one time was accounting for 1 out of every 8 multifamily starts in the country, and they had a change in their tax incentive program, so they had a big surge to beat the deadline. But we think multifamily will be around 400,000 for the next few years. Now, our definition is more expansive than what you see in the department, what you see when they report multifamily housing starts. We're using 2 or more. The traditional definition is 5 or more, and we're using 2+. So if you want to take off 20,000 for the 5 or more because there's roughly about 30,000 units of duplexes and triplexes in the data. So this is a little higher than what you would see when the Department of Commerce reports the numbers. So these are 2 or more. The other thing that's been driving it is there's been a long decline in apartment vacancies that have seemed to stop. We've gone from 8% at peak in 2010. It's down to 4%, and we've now had an uptick. Our sense is the supply is finally meeting demand for apartments. And if we had a guess, is the apartment vacancy rate a year from now will probably be 0.5 point higher than where it is now nationally. And we're seeing signs of overbuilding in San Francisco, New York, and even though Los Angeles remains strong, there's also signs of overbuilding here. This is the CPI for rent that Ed showed, and rents continue to increase, and it's roughly around 4%, but there's an asterisk associated with the CPI number. The CPI oversamples rent-controlled jurisdictions, and it tends to lag what's really going on in the market. In 2013, 14, and 15, the publicly traded apartment REITs were reporting rent increases on the order of 5 or 6%, which was well above what the CPI was showing. So we made the prediction that the CPI for rent was going to go from 3% to 4% because we knew what was going on sort of in the spot market, and ultimately caught up to it. Now the publicly traded REITs, which operate in the higher end, more luxury type apartments where most of the overbuilding is going on, they're reporting rent increases on the order of 2 to 3%, well below the 4%. So our sense is over time this index could come down a little bit on the official CPI as the CPI catches up to what's really going on into the market. There's a lag. But there's a double asterisk here because there's now a whole single-family rental business where we're getting lots of data on the rents in single-family houses because there's a whole bunch of companies that own 150,000, 200,000 single-family houses and rent them as if they were apartments. And there we're continuing to see rent increases of above 4%. So, and when they do the owner's equivalent rent and the CPI, they're going to look more at that 4% number than the tenant rent number. But it also shows with rents going up for single-family rentals is there's still a huge preference for single-family housing. Only it isn't showing up as ownership, it's showing up as rental, to the extent that if their income begins to go up in one form or another, those renters who are living in single-family neighborhoods may ultimately turn out to be owners, and the home ownership rate will go up. So there's a lot of asterisks around the official CPI data. So let me conclude is housing activity. We think we're going to grind higher. We were 1.18 million starts in 16. We think we got 1.27 this year, 1.34, call it 1.4 in 2019. Income, lifestyle, and demographics and zoning are holding back activity. And we think that multifamily housing will continue to boom. Now, they say, David, how can you say that? You told me that rent increases are slowing down, vacancies are going up. Why are you getting a lot of multifamily housing? And the answer is what we were just talking about, is there's a lot of money out there, Ed was saying, low real rates, to invest in income-producing assets. There are a lot of people, a lot of investors dedicated to real estate. But the real estate investor takes a look at what we're looking at. They're seeing all these store closings going on. So they're going to be more reluctant to invest in retail properties, and the money's going to flow into apartments. So people are going to build apartments, and they'll make up whatever pro forma they want to make up to make the numbers work. And apartment construction will continue strong because you don't have the fundamental structural issues in the apartment. But you could get normal traditional overbuilding, but you don't have a structural issue of a technological disruption, which you're seeing in retail. So money's going to leave retail, and it's going to go into apartment investing. So apartment construction will continue to be high. And the good news in this, it is very good news for tenants. Thank you.